Well, it's another year, which means that we've got another Top 10 Tax Change episode dialed up here on Dollars and Cents. You can always count on the IRS to make changes, and you can always count on us to try and keep you abreast of those changes as well. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars, including those dollars that you send to the IRS. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. Joining me on this week's program is fellow certified financial fiduciary who also happens to be a fellow certified financial planner too, and a CPA, Kristen Cayley. Good morning. How are you?
Hi, good morning, Joel. I'm doing great. How are you?
I am doing fantastic. Thank you once again for joining us on this program. You know, this top 10 list that we mailed out to our clients this past week, I used to write it. I have now passed the torch, if you will, to you to come up with this each and every year.
Mm-hmm. Yeah, and this year was a little bit different because there really weren't that many changes. We were still recovering from the changes that came last year. There were a ton of them last year.
Well, and I think you were talking about the fact that a lot of them from prior years were rolling into to 2024.
Mm-hmm.
There was a lot of provisions that were passed, maybe not this past year in 2023, but in prior legislation that had some implementation dates in 2024.
Mm-hmm. Yep, we've seen a couple of those, and then also some that just weren't implemented when they were supposed to be. They've been delayed for some various reasons.
So we will get into all of that, including some of the ones that have been delayed. So I guess we'll get into it. The first one has to deal with required minimum distributions. First of all, let's just recap for our listening audience what a required minimum distribution is in the first place.
Mm-hmm. Yep, so a required minimum distribution is the amount that you are required to take out of your retirement accounts once you hit a certain age. So a couple of years ago, that age was 70 and a half. It increased to 72, and then last year it increased to 73. So just a reminder that that age is still 73.
Right.
And then starting in 2033, it's going to increase to 75.
So it continues to go up, continues to stagger up, obviously reflective of a life expectancy and those kinds of things. Now, you know, the required minimum distribution is a calculation that I know at the office we're doing for a lot of people these days because it is dependent upon a couple of different variables, one of which is that value as of January the 1st, and then I guess the other is that life expectancy value.
Mm-hmm. Yep, so that will be based upon your age, and it's from an IRS table, so they calculate that amount for you.
And it's important. There's a lot of tables kind of floating around out there, you know, because once anything's on the internet, it never goes away. And so there's a lot of different tables out there. So if you're calculating your required minimum distribution yourself, one of the important things is to make sure that you're using that correct table.
Mm-hmm. And the best place to get that from is directly from the IRS website.
Always a good resource. Go to sort of the horse's mouth, if you will, to get the best possible information. But yeah, make sure that you are using the right life expectancy table. Now, here's the thing, and one of the reasons why I think it's good that you sort of made this required minimum distribution concept sort of that first item on your top 10 list is that there's a pretty steep penalty if you don't take it, but similarly that penalty has gotten a little bit easier, I guess, to swallow if for some reason that you miss it. So what was the old penalty and what's the big change on that?
Mm-hmm. So the old penalty was 50% of your missed RMD amount, your required minimum distribution amount. So that's a really steep penalty.
Plus taxes, right?
Yep, plus taxes.
So
on that,
I mean, you could easily swallow up 80 to 90% of what you should have been taking out of that thing if you didn't take the required minimum distribution.
Mm-hmm.
Yeah.
So now that's down to 25%. So that is still pretty high, but not as bad as 50%. And then there is some relief. So if you do miss your RMD during the year, and if you make it up within the following year, it drops down to 10% penalty.
Yeah, that's the big change, I guess. Not just dropping down the penalty, but also giving you an opportunity to sort of fix the mistake if you realize that you made a mistake. So all of that that also is I guess a piece of the good news, if you will, on required minimum distributions and how that works. Now remember, required minimum distribution applies to basically sort of all retirement accounts. There's no required distribution on a Roth account, but on a retirement account, those are the ones that you kind of have to add all up, no matter where they are. Now, you don't have to take it proportionally from each account, right? Mm-hmm. So you can kind of pick and choose where you want to take it, but you've got to calculate up that total value of your retirement account balances. The only exception of a retirement account that you would not need to calculate would be as if you're still working and it's an employer plan.
Right. So a 401k, that sort of thing.
It wouldn't have to kind of count in that so long as you were still working for that particular company.
Right. But if you did hold an outside IRA account, then you would have to take the RMD from that outside IRA account, just not from the 401k.
Correct. Even if you were still working, it's not some work exception where you don't have to take it. If it's in, it would have to be in an employer plan like a 401k or a 403b or something like that, right. And you had to be still working for that employer in order to kind of not have to take the required distribution on that. So, and then of course the other thing, and I think we'll talk a little bit later about this, but qualified charitable distributions continue to be a big part of how people are using their required minimum distributions to try and offset the tax implications of those required minimum distributions.
Yep, and that amount actually increased. So it was $100,000 for many years, and now it's $105,000.
And the weird thing about that, and we've certainly talked about this in prior programs, is on the qualified charitable distribution. Now, again, for our listeners, how that works is in order to have a qualified charitable distribution, you've got to have the check from your retirement account be made payable to that charitable institution. Got to have that. You can't have the money come to you and then you write the checks. It's got to be direct to the charitable institution. It's okay if you have the check come to your home and then you hand deliver it to the charitable institution, but you've got to make sure that is made payable directly to the charitable institution.
Yeah, that's the only way for it to qualify.
Yeah, it's not, you can't take the money and then turn around and write the check. You got to have the check written directly from the IRA to be able to do that. And then the other sort of oddity on this qualified charitable distribution stuff is that the age for when you can do that doesn't mirror, or at one point it did mirror your required minimum distribution age, but it doesn't anymore.
Yeah, so the age for a QCD or a qualified charitable distribution is still 70 and a half, which was the old RMD age. Right. So it didn't increase with the changes, but it does make it interesting because we do have a lot of charitable-minded clients that take advantage of that at age 70 and a half.
Sure, great way to also take money out that otherwise would be taxable, and then you can send that directly to your charity. And the other thing about the qualified charitable distribution is you can do that. If you've got a year where you're trying to achieve a charitable objective, you can actually do more than your required minimum distribution as part of that qualified charitable distribution, up again to that limit that was 100,000. I guess it's now 105.
Right.
So some interesting stuff there as it relates to required minimum distributions, the changing age, the using the qualified charitable distribution, and I guess most importantly, the lower penalty if you make the mistake of missing it. But here's the thing. Why don't you plan ahead and not miss taking the required minimum distribution? One of the best things that you can do is sort of automate that calculation and distribution to avoid that penalty. Anyway, with that, we're going to take a break and continue on with this year's episode of the Top 10 Tax Changes for 2024 as we continue here on Dollars and Cents after these messages. Another year, another top 10 tax change lists from your friends at Nelson Financial Planning. You're listening to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars, including those tax dollars, and more importantly, kind of how to minimize those, or at least understand the latest rules so you don't wind up paying more than what you should. Before the break, we were talking about the required minimum distribution. Obviously, a big penalty there if you don't take it, and how you can ultimately avoid that. On the program, of course, my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning. Dollars and Cents is one of the most widely listened to radio programs throughout the Central Florida region, coming to you on a host of stations throughout that region, and also one of the top 25 financial planning podcasts. So make sure you check us out on your favorite podcast platform of choice. Any trouble at all finding us, go to our website, nelsonfinancialplanning.com, and there you'll see the icons. Click on the one that looks most familiar to you, and you will get immediately connected to our channel on that particular platform. Once there, go ahead and subscribe to us. That way you don't have to do that whole process all over again. My name again is Joel Garris. Joining me on the program, Kristen Cayley, fellow certified financial fiduciary, certified financial planner, and a CPA. Are you planning on adding any more letters to the name here in the new year? Or you got enough of an alphabet
I think I've
soup?
tapped out.
You're tapped out. Enough of an alphabet soup. On the program, we're talking about those top 10 tax changes, something that I used to sit down and write. And obviously, we've passed the torch over to you, Kristen, to kind of, for the past few years, you've been writing these. And obviously, it's a piece, it's interesting, it's a piece that I think a lot of our clients look forward to getting. We mail that out to them. This week, they should have received that in their mail, along with kind of our January welcome to the new year kind of letter that announces our slate of events and those kinds of things that we have during the course of the year, or I guess really the first half of the year is really kind of the list of events that we sent out. And so we'll do a special offer here on the program for those of you who may not be clients of the firm at Nelson Financial Planning. Well, the first question would be, why aren't you, right? Number two, though, if you're interested in getting your own copy of these top 10 tax changes, we would encourage you to call the office, 407-629-6477, or you can go to our website, which is, of course, open 24 hours a day, 7 days a week, 365 days a year, and fill out the contact form there requesting your top 10 tax changes for 2024. So one of the changes that I guess is sort of standard every year, right, is kind of they adjust the limits for how much you can contribute to the various retirement plans. So what are some of those adjustments, Kristen, that are on tap for the year 2024?
Yes. So it's important to kind of keep these in mind. So if you are maxing out these limits, just to make sure you update it for 2024. So we'll run through these. So the updated 401k, 403b, and 457 limits are $23,000. The catch-up remains at $7,500, and this is for those that are over age 50. The traditional IRA and Roth IRA limits increased to $7,000, with the catch-up for those over age 50 remaining at $1,000. Simple IRA limits increased to $16,000. Simple IRA, the catch-up is still $3,500. SEP IRAs increased to $69,000, and HSA limits increased for individuals to $4,150, and for family plans at $7,750.
So sort of your normal inflationary adjustments, but here's the thing about how inflation works. It does sort of, I guess, erode or increase effective numbers over time. So if I'm hearing you correctly, Kristen, for 2024, if I'm over 50, and I would fall into that category these days, then I can actually put $8,000 in a traditional IRA or traditional or Roth IRA if I wanted to.
That's right.
So that's interesting, because I guess this tells you how long I've been doing this. I remember the limit being $2,000. So that has quadrupled thanks to these inflationary increases, but albeit that's over bit of a period of time. Anyway, the next rule, the next tax change that you talk about in your top 10 tax change list, Kristen, is all of these required distribution rules. And where this comes from is that the big change happened in 2020, eliminating the stretch IRA, which we feel is perhaps one of the largest tax grab by the folks in Washington that you don't know about. Let me repeat that again. This is one of the largest tax grabs by the folks in Washington that you don't know about. And here's why you're not going to really know about it, is that it happens when you die. So when you die and your beneficiaries inherit your retirement accounts, they've got to pay money on the amount of those dollars that they inherit. Now, under the old rules, Kristen, right? A stretch IRA, they had a long time to do that.
They could stretch it over their lifetimes, which is pretty incredible.
Rest of your lifetime. That's where when you have these tricks of how maybe you name grandkids or even great-grandkids as beneficiaries of IRAs, my goodness, you're talking about a potential of 70 or 80 years of a distribution schedule that really does spread out the taxes, allows the balance to continue to grow on a tax-deferred basis. I mean, really, truly powerful stuff that all changed in 2020.
Yeah, unfortunately. So in 2020, the new rule is that if your beneficiaries inherit your retirement accounts, they now have a 10-year window to liquidate the full account.
And this is one of those things you were mentioning earlier in the program about there's a lot of these changes that the IRS hasn't really caught up to in terms of issuing out some final sort of rules on how to deal with. And this would be one of those as well, where we've seen an attempt to sort of issue out some rules on what this 10-year window looks like or what you're supposed to do in the 10-year window. And then other times where the comments from the IRS have been met with resistance and questions. And so ultimately last year, I think they kind of landed on where they're going to be. So tell us a little bit about kind of what those rules are and kind of their, I guess, quasi-final form from the IRS?
Yeah, so the 10-year window still remains. You have to liquidate the account in 10 years. The real question was, do you need to take out an RMD throughout those 10 years? And the IRS has come to say, yes, if the original owner of the retirement account was at RMD age or already taking their RMDs, then you as the beneficiary should be taking out a small amount over that 10-year period each year.
And that's based upon the amount of that required distribution that then you would have to take is going to be based upon your life expectancy, much like the old stretch rules.
Correct.
So there's a minimum amount, little minimum amount that you would have to take, leaving the rest of the account to grow on a tax-deferred basis. But by year 10, you got to take the whole thing out.
Right. So it kind of makes sense to take some out along the way instead of waiting till year 10 and having the massive tax bill. But this is mainly just for those that had that RMD requirement on the decedent's account. Yeah,
so a little bit of a distinction there, but obviously still that, the 10-year rule applies. Now, interestingly, it also applies to Roths too, doesn't it?
The 10-year year does apply to Roths, yeah.
Yeah, so it doesn't matter whether you inherit a retirement account, an IRA, or a Roth, you're still going to have to take it all out. And I guess the heart of it is that the folks in Washington, well, they desperately need your tax dollars to fund whatever it is that they're funding up there. And ultimately, this is a good way to kind of take those assets out, right, that are growing tax-free in the case of the Roth or growing tax-deferred in the case of a traditional retirement account, and sort of force you to pay the taxes on it by virtue of these required distributions.
Right, and the penalty is the same for these required minimum distributions. Okay. It is 25% if you miss it.
Okay, all right. So then there's some pretty significant penalties that come into play as well on that. We mentioned the qualified charitable distribution amount sort of increasing from 100 to 105,000. There's another item that also has increased as well that you mentioned in this top 10 tax change list, and that has to deal with gifting. So we're going to take a break, and when we come back, I want to talk a little bit about gifting, what that means, what the tax implications are, and kind of how that plays out. So we'll tackle that topic next here on Dollars and Cents with Joel Garris and Kristen Cayley of Nelson Financial Planning. Talking about some of the big tax changes for the year 2024, sort of an annual exercise that we do at Nelson Financial Planning. I used to sit down and write the top 10 lists, and then we sort of pass the torch to fellow certified financial fiduciary, certified financial planner, and CPA, Kristen Cayley, at the office here at Nelson Financial Planning, and never short, right, on coming up with 10 changes in the tax code for any particular year, right?
No. Luckily, there's always changes, so we've always got top 10 to give you.
Always changes. So if you're a client, you received a copy of that in the mail this past week in connection with our general or welcome to 2024 letter that lists the events and things like that are happening in the first half of the year here at Nelson Financial Planning. If you're not a client, then you are certainly welcome to give us a call or go to our website, nelsonfinancialplanning.com, to request your free copy of our top 10 tax changes for 2024. Happy to get that copy out to you because I know a lot of clients read this pretty carefully because it's a big part of kind of how they think about their taxes and organizing their information, that's for sure.
Yeah, and we really do try to tailor it to tax changes that would benefit you or that apply to you.
Sure. So typical retiree investment, those kinds of things is really the focus. Before the break, we mentioned one of the changes that happened that was kind of more inflationary, and that was the gifting exclusion, which obviously, to those folks that want to help out family or friends or those kinds of things is particularly important. So that gifting exclusion went up again for 2024.
So that is now $18,000 is what you can gift a single individual without incurring any sort of filing requirement for that gift.
Right. So, and that's what you just said is a pretty fair distinction, and the thing that people need to kind of be aware of is if you give more than that of a gift, then it doesn't necessarily generate a tax consequence per se, because then that becomes part of the unification of the gift and estate tax exemption, which today is like $13-14 million. But there is a filing requirement.
Right. It's Form 709. It's a gift tax return just to show that you gave a gift that's over that $18,000 limit.
Yeah. So again, no tax implications on that one, folks, but good to sort of do that informational filing on a lot of levels. What that technically does is that reduces your estate tax exemption when you die. So instead of it being like, 14 million, we'll call it, pretty close to that. Then it's, when you die and you're only allowed to pass 13.9 million of assets. Okay. So again, it's just an informational filing for the most part. We certainly do those from time to time at the office, particularly if a parents wants to help kids with a down payment or something like that. That's typically where you would see that, particularly with housing costs as much as they are here in Central Florida. But generally a gift, not tax deductible or anything like that, because you're giving it to a family member because it's not a charity, even though they may act like a charity. But no tax consequences either way. You don't have a reporting requirement if I'm the recipient or anything like that. So know that the gift exception did increase, and that's per person, per individual.
Correct. Yes. So if you're a married couple, you can give up to $36,000 to a single person without having to file that tax return.
Or if they were married as well, then you could, in theory, go all the way up to $72,000.
Correct. Yep.
So some interesting ways to kind of take advantage of that to get to some pretty high numbers. So speaking of high numbers, okay, so let's get down to like the total opposite of high numbers, and that would be these changing thresholds on these 1099Ks, and we've got an update now. I know. You joined me on the show back in the middle part of December, so December 17th, to talk a lot about this. So where did the IRS sort of wind up on this 1099K? Well, and what is this issue that we're talking about in the first place?
Right. So I think we've had a couple shows on this all throughout 2022 and 2023 because it's really been an ongoing issue. So this has to do with the 1099K reporting. So 1099Ks report third-party payments that you receive or send through platforms such as Venmo, PayPal, Ticketmaster, Facebook Marketplace, all those sorts of places. So it used to be that you only received this tax form if you had over 200 transactions or receive payments over $20,000. So that's a pretty high amount.
Pretty
Unless
high
you're
threshold.
doing some
Yeah.
serious business on these platforms, generally you wouldn't receive that tax form.
Right. That's not just selling your Taylor Swift tickets. Okay. That's like engaging in the business of selling Swift tickets all around the world.
Correct. Yeah. So now what they did back in 2021 is reduce the threshold down to 600. So if you had more than $600 of sales or transactions, then in theory this tax form should be issued to you.
Right. That's like a half a Taylor Swift ticket right there. Yeah.
So there's been a lot of kind of backlash from accountants and just these platforms because that was a major change that they really didn't have enough time to implement.
Right.
So now the IRS has come up with a time schedule. So instead of it being immediately 600, what's going to happen is in 2024 it's going to drop down to 5,000, and then 2025 drop down to 600.
So certainly an opportunity to sort of gear up for it. This is not going away. I think but let's not live in a fairy tale world of somehow this is going to disappear and all these issues are going to we're not going to have to deal with. It's not going away. It's just a question of getting their hands around it in order to implement it.
Correct. Yeah. And I know a lot of the platforms are already starting to issue them. So they're kind of getting geared up so that you might receive one for your 2023 taxes, but certainly expect one in 2024 if you had over $5,000 of transactions.
Well, and certainly, and we talked about this on the program here 3 or 4 weeks ago, the December 17th program, where we went through specific examples, 4 specific examples of the applicability and the things that you may have to watch out for if you wind up getting these 1099Ks. So we would encourage you, we're not going to kind of go back through all of those because we devoted nearly a whole show to it, if I remember correctly, because this really is kind of a topic that has a lot of conversation in it, because a lot of people do that, right? A lot of people use Venmo. A lot of people, sell stuff on eBay or Amazon or whatever the case may be.
Yeah, or it's even reimbursement. So if one of your friends picks up the check at dinner and you reimburse them, that could even trigger a 1099K.
Yeah, so that becomes pretty significant. So we would encourage you to go into the archives, go to the channels that are on the various podcast platforms or our YouTube channel, which is always can be found by searching Nelson Financial Planning on any of those channels, dollars and cents, those types of searchable words will find our channel. If you still get stuck with it, you can always go to our website, Nelson Financial Planning, and look for the icons, click on them, and you'll get connected over to those channels. But really check out that if this particular issue applies to you, or you've done some transactions on some of these platforms, we really encourage you to kind of dig back into that December 17th show, because we really do kind of talk about this one in great detail. So this one's going to be messy. That is for sure.
I think the number one thing to remember is if you do use these platforms, it does not hurt to check to see if a tax form was issued to you, but it will really hurt if there was one issued and you don't report it on your tax return.
You know what? That's a phenomenal point, Kristen, that I think it really bears repeating, because if you think about these platforms, most of these platforms are online. Mm-hmm. So you're not going to get the 1099 in the mail. Mm-hmm. You're going to have to go in and you're going to have to find where the tax form section is. And then you're going to have to make sure that you download the tax form.
Yep. Yeah. Especially with platforms like Venmo that might not even have your address linked. Yep.
So be careful with that one, folks. That is for sure. So I guess we're rolling through it.
1 minute.
We've got so much to talk about here on this list. Another one that I know we've talked about briefly on the show before is the tax-free rollover, right, from 529s to Roths. I guess that starts beginning in 2024. That's a new feature that you have for the year 2024. Tell us a little bit about kind of what's involved in that.
Mm-hmm. Yep. So that is if you have a 529 plan for one of your beneficiaries. You don't use all the plan assets. You can roll it into a Roth IRA for that same beneficiary up to $35,000.
So pretty interesting opportunity to use some of those leftover proceeds. Sure, I know many people with leftover proceeds in college savings accounts given the cost, but hey, certainly something to know that at least you have that option to use that. Couple of caveats: the account's got to be open for 15 years, things like that. So anyway, we're going to talk more about these tax changes for 2024 coming up next here on Dollars and Cents with Joel Garrison, Kristen Cayley of Nelson Financial Planning. Big tax changes for the year 2024, as there is every year, although, as we said at the top of the program, Kristen, not quite as many this year, perhaps. I guess that's a representation of the dysfunction in Washington during the course of last year. But certainly a number of prior changes that are rippling through, that are coming online in sort of various stages. This next one that you talk about in your top 10 tax list has to deal with sort of the expansion of Roth options among employer plans. So tell us a little bit about that one.
So previously, employees could only take their matching contribution. So that's the match that the employer gives you. Usually it's about up to 3% or something along those lines. It used to be only taken on a pre-tax basis, but now you can elect to have that taken on a Roth basis.
So once again, we see that sort of that permeation of Roth being an option. It started out a few years ago, not that many years ago, in terms of being an option in 401k platforms and things like that. And a lot of 401k platforms still have not fully adopted it. But now Washington basically said, okay, we're going to have this at least as an available option. Maybe your employer plan is current and up to date with these latest changes, or maybe not. It sort of depends on where your plan is.
Yeah, I think the changes are still rolling out in the platforms themselves. So while the IRS may have allowed you to take Roth matching contributions, the platforms may not have adjusted to the change yet.
And similarly with SEPs and things like that as well, SEPs and Simples, you now can do kind of that Roth that Roth option, where before that wasn't really even an option on those types of employer plans. So now the next one, and this is one that I think we're going to get a lot of questions on. And this next one, folks, you've got to be really, really careful on, because I think people go into the car dealerships and they buy cars, and they're electric cars or hybrid cars or whatever the case may be. And I mean, I guess this goes without saying, but I'm going to say it here on the program. Your car salesman is not a tax expert. Okay, so let me just get that out there. I mean, I know your car sales guy or gal is, I mean, I'm sure you like them and all that, but they're not CPAs, they're not tax experts. So before you bank on the credit, you may want to do some investigating. So how should people start investigating their ability to get that tax credit, if you will, for the purchase of a clean vehicle?
Yeah, so there's a couple requirements in order to get the credit. So the first requirement is that if you're going to purchase a new electric vehicle, the credit's up to $7,500, but you really need your income limits to be below the threshold. So that's $300,000 for married couples and $150,000 for single filers. That's kind of the main requirement, is you can't go over those income limits or you lose the credit. The other requirement is it does have manufacturing requirements on the battery and the materials. So if you think your car may qualify, I would recommend going to fueleconomy.gov. That's the IRS recommended website. Check the make and model and make sure it actually does qualify, because if it actually does not qualify, then you lose the full credit.
Right, which would not be good, combined with the fact that, the surprise of if your income happens to be over these thresholds, then you would lose the credit as well. And that's a pretty big shift on a tax return when you think about $7,500 going against you when you planned on that being a tax credit. The other change is that who's able to give you the credit, I guess.
So starting in 2024, instead of having to claim it on your tax return as a credit, you could transfer the credit to a registered dealer who would give you an immediate sort of write-off on the purchase price.
Wow. So if I were to go and buy a car, and assuming that it was the right kind of electric car that satisfies based on the IRS's fueleconomy.gov website, right? So I got to check that out first before I even go car shopping, so I don't fall in love with something and then find out it doesn't really qualify because they sold a bunch of them last year that got them over the threshold, or the battery's made in Yugoslavia, wherever it's made. So Yugoslavia doesn't exist anymore. That's how old I am. What the other thing I need to be aware of is, I guess, the kind of what the income limits are and things like that.
So if you fall comfortably within those income limits, then it's probably okay to transfer the credit to the registered dealer and get the immediate write-off. But if you don't think, or you might be on the fence, or you're just unsure, just forego transferring the credit and take it on your tax return, because if you go over those limits, you will have to repay the $7,500 on your tax return.
Yeah, that's pretty
It's a steep price.
And you're not going to be able to go back to the dealer and complain because, this is a tax matter, not a car dealer. It's not going to be covered under your car warranty, that is for sure. So something to certainly be aware of there. Another thing that I guess has expanded a little bit is the ability to take money out of a retirement account in certain situations. And so those situations have certainly expanded, and the goal there is that if you're taking money out, to try and avoid the penalty if you're not 59 and a half. So kind of what are we talking about there, Kristen?
Yep, so they have now come out with a qualified disaster distribution. So this is if you reside in a federally declared disaster area, you can withdraw up to $22,000 from your retirement plan without the 10% penalty. You still are responsible for the ordinary income taxes on it, but just not the 10% early withdrawal penalty.
And this was actually a new one for 2023, if I recall correctly. And there was a lot of holdup on getting the IRS, for the promulgation of the final form, if you will, that needed to be used to be filed with your taxes. I remember last year there's probably 5 or 6 returns that we were kind of just sitting on waiting for that particular form.
Right. We had some people qualify because Hurricane Ian that came through in 2022 actually was one of those federally declared disasters, and the $22,000 of distributions did qualify. So it was worthwhile to kind of hold those tax returns until the form was processed.
So let's get to, I guess, to the last one on your top 10 list, because this one is pretty important and people need to be aware of it. What did you say? I guess you didn't save the best for last. This is kind of the worst for last. So what is it?
This is just kind of a reminder and a heads up that interest rates are high, so the IRS is also imposing some high interest rates. So the penalty for an underpayment of estimated tax is 8%.
Wow. Yeah. So that's getting up there pretty steep. So if you're one of those people that said, I'm just going to pay it all at one chunk, when my taxes are due, you really want to kind of unwind that analysis, because at 8%, that's pretty costly.
It's a steep cost.
That is a very steep cost. So make sure you're doing the right amount of withholding along the way. Otherwise, you're going to run into trouble on that, and trouble in the form of an 8% interest rate. So that was 10. There's always sort of one more that I guess, Kristen, that, or at least when I was writing the top 10 list back in the day, there was always kind of one more that I said, man, I wish I could get one more in here. What was the one more that you wish you could have gotten into your top 10 tax change list for 2024?
Yep, so this has to do with the premium tax credit. This was also on our list last year. It's been on the list for a couple of years. So this is if you take the premium tax credit under the marketplace insurance. So they've extended the limitations that they had back in 2020. So essentially they removed the upper income limitation. So everybody can qualify for the marketplace insurance. So what this means is that the benchmark is now 8.5% of your income. So if your premiums are over that, you're limited to 8.5% of your income.
Well, and certainly this was a nice shift, because I remember prior to 2020,
1 minute,
where we had, just folks over that income threshold by a few dollars, and then, you had to trigger the full recapture. I mean, you're talking $12,000, $15,000 swings on tax returns. Yeah, pretty significant stuff. So, but anyway, good stuff in your top 10 tax list for 2024. Thank you for sharing that on this week's program. If you'd like a copy of Kristen's top 10 tax change list for 2024, just give the office a call, 407-629-6477, or go to our website, nelsonfinancialplanning.com. There you can request our top 10 tax change list, along with, of course, a free copy of our new book, Next Gen Dollars and Cents. We got a chapter in that book on taxes as well. So make sure you check all of that out when you visit our website at Nelson Financial Planning. This has been Dollars and Cents with Joel Garris and Kristen Cayley of Nelson Financial Planning. Thank you for joining us on this week's program.